Hello everyone, I hope so you will be fine. So guys, today we are going to practice a certain exam standard questions related to the portfolio management. So last time we discussed the portfolio management and we discussed like how to calculate the expected rate of return. We discussed this thing first last time, how to calculate expected rate of return. So then we also discussed how to calculate the standard deviation. Then we also discussed how to calculate the coefficient of variation. We also talked about something about covariance, and we also discussed about like what is the beta and what is the capital asset pricing model. So these things we have discussed under the topic of portfolio management. So this is the name of actually the topic under this topic. So we have discussed these things. So now we are going to just practice the questions what we learned last time to see how these things can be tested in your exam. So here we go. We have a first question on your screen. So a company is considering investing into two of the following securities. So like we want to decide actually in which two securities we should invest. So here we go. We are provided with the information of security A. Security means a stock or bonds. Okay. So security B and security C. So we have a three these securities and this is what is the expected annual return. So in the last class, we discussed how to calculate expected annual return, but it is given here. So security A offering 14% return, security B is offering 8% return, and security C is offering only 1% return, okay, annual return. So this is the beta given relevant to each security. Beta, I told you last time, beta always measures the risk of individual security, okay, as compared to the market. So this discussion we have made last time. So here we have a beta 1 is available for security A and beta minus 1 is equal for it's for the security B, and then we have here for security C there is a 0. So now guys, here we are discussing now which two security combination would best limit the risk. So now let me give you simple example. So I told you like portfolio last time. What is portfolio? Portfolio means a simply combination of different investment. For example, if you have money, you may invest into the stock of company A and into the stock of company B as well. You can also invest your money into the stock of company C as well. Maybe these companies might belong to different industries. For example, maybe company A is from textile industry, company B is from maybe chemical industry. So I told you last time, like, what is our objective for the portfolio management? So objective, I told you last time that objective is that we want to minimize the risk and maximize the return. So this is what is our objective. So like whenever you invest in the portfolio, our objective is to minimize risk and to maximize the return. So then I told you while we select the securities to invest, like should we invest into A, B, or which what in which combination we should invest. I have explained last time. So I told you we always search the companies which has inverse correlation. Correlation, for example, plus what does mean by plus one? It's kind of plus one correlation, and this is like a minus one correlation. So I told you last time what does mean by plus one and minus one. So I'm just quickly repeating. So for example, if this is the company A and this is overall market, okay, overall market means a stock exchange, you can assume, okay. So plus one mean to say, if for example, if overall market will go up, for example, maybe the stock prices in the market will go up. So if it is plus one, so company A stock price will also go up, okay. If overall market will go down, so company A price will also go down. So this is what does mean by plus one. Like if like both stock and market, they will move in the same direction. If market will go up, stock price will also go up, and if market will go down, stock price will also go down, okay. Then I told you what does mean by minus one. Minus one, for example, again this is the company A, this is our overall market. Minus one mean to say if market is going up, So now this stock is inversely related with the market. For example, if market is going up, so stock will go down, it will underperform. Okay. And if market is going down, stock will go up. Now this is what does mean by plus one and minus one. Now, now the question is, so like which two securities? You have to tell two securities like either A or B or A or C or A or B or maybe B or C. Which two securities combination would best limit the risk? I told you last time. So whenever you are managing portfolio combination of investment, so you should always select the securities with inverse correlation. Why? I'll tell you why. Why we want to select the securities with inverse correlation, because our objective is to minimize risk and to maximize the return. So if you will select, for example, if company A is having positive correlation and company B is having negative correlation, so what will happen? For example, this is the company A, this is the company B. If we will select the stocks with inverse correlation, minus correlation, okay, so what will happen? For example, in case if company A will make loss due to any reason, for example, stock prices are going down, so you may lose the money on your investment. At the same time, company B will make gain. So what will happen? This loss will be netted off against this gain. Understood? So this will net off. Okay, so that is why we always select the securities with inverse correlation. And now if you will look at here the C, the security C is beta is zero. Zero beta means it has no correlation. It has no correlation. Okay, so we cannot find the correlation between company C and overall market. So that is why what is the best combination where you can eliminate the risk? It should be investment A and investment B. Because on investment A, if you will make loss, so on investment B, so you will make a gain, right? So this is how you can net off. Now here you have to select two securities in one option. So here is written A and C. Do you think A and C? No, C is not having any correlation. So you should not invest. So you should select the securities with inverse correlation, right? Combination you have to select. So one should be with the positive correlation. So one means what? Perfect direct correlation, right? And minus one means a perfect inverse correlation. So it means best combination is what? A and B. So A and B, where is the answer for A and B? So if you look at here, so this is the B option is the correct, because here these percentages are assumed. They are told you, for example, if A will increase by 50%, so B will decrease by 50%. Or you can say other way, if A will decrease by 50%, B will increase by 50%. So this is what is the exact, actually minus one or plus one mean to say they are changing with the exact proportionate. And proportionate here they gave you as example 50%. So no worry, but A and B is the best combination for investment. I hope so it is clear. Now we have a question number two. So here we go. Let's have a look what is this question is. So guys, question is based on the following information about the stock price increases and decreases. Okay, make an estimate of the stock beta. So this is actually the question. You have to make an estimate of the stock beta. Okay. So for example, what happened now in July? What happened? Stock one, there is one stock, for example. So stock prices has increased by 1.5%. And if you look into the market, so market has like the market has gone up by 1.1%. Now I have a very simple question. Tell me, stock, the change in the stock price is greater than change in market, right? Because stock prices has increased by 1.5% and market, overall market has increased by only 1.1%. Then in August, what happened? So stock uh, price has increased by 2% and market has increased by 1.4%. Again, what happened here? Again, the change in stock price is greater than change in market. So here is also same story. So change in stock price is greater than change in market. In August, same stories. Change in stock price is greater than market. So then in September, what happened? Stock value has decreased by, because it is minus, has decreased by 2.5%. and market has decreased by only 2%. Market has gone down by 2% only, right? So it means again here, stock change in stock is greater than change in market. So I told you last time. Now the question is make an estimate of the stock beta. So I told you beta values, there are three types of beta values are given. So if beta is 1, so interpretation I'm repeating. So it means, let's assume if this is the stock of any specific company, let's assume A, and this is the market. So what will happen? If beta is 1, beta is always for this individual security, okay? And beta always measure the risk, volatility as compared to the market. So if beta is 1, what it means? If market will go up by, let's assume 10%, so this stock price will also go up by 10%. Okay, if market will go down by 10%, stock price will also go down by 10%. These percentages are assumed only. It could be 20%, 30%, right? So this is what is the exactly meaning of beta 1. So what if beta is greater than 1? If beta is greater than 1, so what greater than 1 means? It could be 1.5, 1.3, 2.2, it could be any value. So it means what will happen here? If market will go up by 10%, so this stock price will increase by more than 10% because beta is greater than 1, and beta always tells us about the risk, right? And for example, if market will go down by 5%, so this stock price will go down by greater than 5%. Okay, then what does mean by beta if beta is less than 1? If beta is less than 1. So again, for example, if market will increase by 5%, less than 1 mean to say this stock price will increase but by less than 5%. But if this, for example, market is going down by 10%, so this stock price will go down by sorry, okay? Not greater than, less than. So by less than by 10%, right? Now tell me here, in this scenario, in the question, this is what is happening, right? This scenario is happening because proportionate of change is not same. It is different, right? If, for example, stock is, if market is has increased by 10%, so stock price is moving by greater percentage. So you can realize here, stock has increased by 1.5% and market has increased by only 1.1%. See, right? So this scenario is there, right? Whatever I was telling you here, right? So same here, look in the August. If stock price has increased by 2%, market has increased by only 1.4%, right? So this is what is mean by beta is greater than 1. And look into the September. So if stock price has decreased by 2.5%, but market has decreased by 2%. So again, the same scenario. Okay. So it means what is the beta? Beta is estimated beta value will be greater than 1. So here we go. Now we have to select the answer because our question was we have to make the estimate of the beta, right? Estimate of the beta. So option number 1, there is no consistent pattern of returns. No, it's not like that. So beta is greater than 1. Yes. The stock beta is greater than 1. That is why it has greater variations as compared to the market. So beta is less than 1. No. If beta is less than 1, so then stock price should move with the smaller variation as compared to the market. But in this question, prices stock price is moving with the greater variation than as compared to the market. So beta is equal to 1. No, it's not equal to 1 because if beta is equal to 1, then stock and market, they should change with the same proportionate. But here percentages are different, right? And stock is having more variation as compared to the market. So it means which is the correct option? B is the correct option. I hope so it is clear, right? Is that clear? So then we can move forward. Okay. Now we have a next question here. So here, if you will look at here, uh, now let me read the requirement first, and you should also develop this habit. Try to always read the requirement. Mostly requirement of the question is written at the end of question, but sometime it may be written in between the question. If it is written at the end of the question, so that's good. First read the requirement. Otherwise, you have to go through the question first. So the question is, what is the beta coefficient? of this stock. So beta is asking. So what is the value of beta is actually he's asking. So let's read the question again. Now they're saying a stock has expected return of 16%. This is expected return using capital asset pricing model. CAPM equation we discussed last time, right? And for CAPM equation, we discussed that how you calculate required rate of return. Required rate of return for common shareholders. Okay, common shareholders. So what's the formula? Formula is risk-free rate of return plus beta coefficient into RM. RM stand for return on market minus what? Risk-free rate of return. So this is the formula which we will use. Okay. I told you this side RM minus RF. This is also called market risk premium. What it is called? Market risk premium. Like RM minus RF is called market risk premium. But if you will look this whole side, so this is called only risk premium. Okay. Risk premium, how you calculate? So you need RM, return on market, minus RF, risk-free rate. So whatever the answer you will get, that answer should be multiplied with the beta. So then it is called risk premium. But if you will take RM minus RF, this is called market risk premium. So this is the equation of capital asset pricing model. And this equation we discussed last time, how do we use this equation to calculate the required rate of return for common stockholders. Okay. So now here we are discussing question. So this thing, a stock has an expected return of 16%. Okay. Using capital asset pricing model, if the expected rate of return on market, this return on market is 12%, and the risk-free rate of return is 4%. So then what is the beta coefficient? Okay. So let's solve it now. I'm going to just put the data into this equation and we have to find out the beta. So now guys, please remember here, we have a risk-free rate of return. How much is given risk-free rate of return? This is the risk-free rate of return, 4%. So we'll write 4% plus beta value you have to find out. Okay, RM, return on market is 12%. We'll write 12% minus RF is 4%. Okay, now guys, please. And he told you expected rate of return, our required rate of return, answer is 16%. He told you answer. Required rate of return, he told you 16%. So only missing thing we have to calculate here, beta. So we have to find out here beta value now. Now guys, there could be a different ways to solve. So mathematically, first way I will tell you, then I will tell you if you are not good in math, we can use other way. So mathematical way is what? So we can solve it. So we have a required rate of return 16% equals RF. And then we have a beta value you have to find out. Then we have a RM is 12%, then 4%. So let's write it will be 16% equals 4% plus beta value you have to find. Then we'll solve this side. 12 minus 4 is 8%. Now what we can do? 16% minus this will be now minus 4% equals beta value into 8%, right? Now further we will solve. This will become 12% because 16 minus 4 equal beta value into 8%, right? Now we can find out the beta value. How you can find out the beta value? So 12%. This is the multiplication. Here you will divide now 8% equals beta value. So you will get beta of how much? Beta of 1.5. Okay, this is the math. This is how you can find out by using mathematical equation. It means answer is 1.5, beta value is 1.5. But other way, if you don't know math, so you can do this way also. So just write this information, the formula here. This way write the formula. Okay, put the data here. And now on the trial and error base, because if you are not good in math, you can do trial and error. Trial and error is what? We know there are four options, right? Option is 1.5, is second is 2, third is 3, fourth is 0.5. So what we can do, so we can put here each option like 4% plus beta. First put this first option. First put here first option, which is what? 1.5. Okay. Into 12% minus 4%. And then solve. If you are getting exact 16% answer, if by solving this, if you are getting 16% answer, it means that is your correct answer. And by the way, here you will get 16% answer. How? 12 minus 4 is 8. If you will multiply 8 with the 1.5, it will be 12. 12 plus 4, you will get 16%. So this trial and error you can do, right? So if you are not getting with the option A, then put it here 2 one time and then check you are getting 16 or not. So this way you can also work. Understood? So both way is understandable. I hope so it is clear. If you have any question, you can ask me. But for this question, option A is the correct answer. Do you have any question, guys? So we have a next question now. They're saying a market analyst has estimated the equity beta of company to be 1.4. Equity beta is 1.4. It means beta is greater than 1, right? If beta is greater than 1, so that stock has more variation as compared to the market overall market. Okay. So here beta is 1.4. This beta implies that the companies. Okay. Now if you will look, what does mean by 1.4? So now we got a four options here, right? So option number one is what? They're saying total risk is higher than that of the market portfolio. This is the first option. Okay. Second is what? Unsystematic risk is higher than that of market portfolio. Do you remember unsystematic risk we discussed, right? Because beta always reflect the systematic risk, not unsystematic. And systematic risk is the risk which cannot be diversified away. Even you are holding, diversified investments or diversified portfolio, still this risk you are facing. For example, I gave you example while I taught you the topic. I gave you example of war. For example, if there is a war will affect all the companies, right? Not only one specific company. It means even you hold the diversified portfolio in case of a war, every company will suffer and your investment will also suffer, obviously, right? So beta represents systematic risk, not unsystematic. Unsystematic risk is the risk which you can diversify away by holding the diversified investments, right? So beta doesn't represent unsystematic risk. Beta represent always systematic risk, the risk which cannot be diversified away by holding the diversified investment. So that is why the investor, they always ask the premium for the risk which they cannot remove by holding diversified investment, right? So beta doesn't represent unsystematic risk. If you look at C, so they're saying the beta implies that systematic risk is higher than that of the market portfolio. It's not a total risk. It is only a systematic risk. Like this systematic risk could be a risk of war. It could be economy recession. For example, if there is a recession in the economy, obviously every company will suffer, right? So it always represents the systematic risk. So this is actually the answer of the question. Then look at the D, why it's not. So systematic risk is lower, not lower, because beta is greater than 1. Risk is higher. So risk is higher, okay, of a specific stock as compared to the market. Understood? It's not a lower. So systematic risk is lower than of market portfolio. No, it is higher. So option C is the correct answer. I hope so it is clear. Okay, guys. So now we are discussing next question. Question number 4. So if you will look at the requirement, so requirement is using the capital asset pricing model, CAPM. So do you remember the CAPM equation? So CAPM equation is required rate of return for equity holders equals risk-free rate of return plus beta into return on market minus risk-free return, right? This is the question. Now, if you look at here, so they're saying using the CAPM, the analyst estimate the next year risk premium. It's not a market risk premium. I told you this portion is called market risk premium. But this portion including beta, this portion, okay, is called risk premium. Now you have to calculate here risk premium for the stock, okay? So it means how you will calculate. So you need a beta value, you need a return on market, and you need a risk-free return. Okay, so let's have a look now to the question. An analyst of the common stock estimates the following information for next year. So expected return on the market is 12%. Okay, this is return on market, which is 12% minus Expected return on treasury security. Treasury security means a government security. It is 5%. This is risk-free rate, guys. I told you return on government's uh, bills, okay, treasury stocks. So these are called risk-free rate of return, which is 5%. Now the expected beta of the stock is 2.2. So beta is 2.2. Now you will solve it. So if you will just solve this, will give you risk premium. So 12 minus 5 is 7% into 2.2. If you will just multiply, so you will get, I believe you will get 15.4%. So this is the risk premium. Okay, but please make sure if in the exam is asking you market risk premium, then you have to take only RM minus RF is your market risk premium. But risk premium is once you will take market risk premium multiply with the beta. Okay, actually this is the total amount of premium that the company should pay to compensate the investor for the risk which he is taking. Understood? So answer will be 15.4%. So A is the correct answer. Understood? So moving to the next question now. So here we have a question now, guys. I need concentration again. So first, so now the requirement is which investment should management make? Which investment we should make? So now let's read the question. Okay, actually it's a decision in which stock we should invest. So now the question is the betas and the expected returns for the three investments being considered are given below. So we have our expected return from three returns expected. Okay. So we have investment A, beta is 1.4, expected return is 12%. Investment B, beta is 0.8, expected return is 11%. Investment C, beta is 1.5 and expected return is 13%. Okay, this is the expected return. Now the return on the market is 11%. This is RM, return on market. Okay. And the risk-free rate is what? 6%. So if the capital asset pricing model is used for calculating the required rate of return, if you're using CAPM to calculate required rate of return, which investment should management make? Guys, simply here what you have to do. So here, when you are taking decision here in which investment we should make, okay, so we got a couple of options down. So what you will do first, you will calculate required rate of return by using capital asset pricing model for each investment. Then you will compare with the expected return. Okay, simply required rate of return is what? Required rate of return means that this is what is your demand, what you should demand, okay, as per the risk which you are taking. But expected return mean to say what return you can expect from the stock or how much return that stock is expecting to give you. Okay, you will compare these two returns. Okay, if your required rate of return is less than expected rate of return, in that stock you will invest. So that investment should be accepted. Reason, because for example, required rate of return is 10%, like your demand is 10, but you are expecting the return from the stock 12%. It means your demand was only 10, but expected return is 12%. It means you can generate more than your demand. It means in that scenario you should accept. if if your if your required rate of return, another scenario, if your required rate of return, which you will calculate by using CAPM, if required rate of return is greater than expected return, okay, so in that scenario, please, you should reject that investment. Don't make investment into that. Understood? So this is what you have to do. Now expected returns are given, so what we have to do, we have to just calculate required rate of return for each investment. So how you will calculate required rate of return for investment? So we got three investments here. So we'll apply the CAPM equation. What's the CAPM equation? So we'll take here required rate of return equals risk-free rate plus beta into return on market minus what? Risk-free rate. Understood? Okay. So first we are calculating for investment A. So investment A. So what is risk-free rate is given 6%. plus beta value for investment A is how much? The beta value is 1.4. Okay, 1.4 into return on market is 11% given here. So 11% minus what? 6%. Just solve it. If you will solve, so you will get how much return? Required rate of return. It will be 13%, I believe. Okay, if you will just solve it, so it will give you 13%. So one answer we got for investment A. So similar way you will solve for investment B also. So again, risk-free rate is not going to change. Just take the beta of B, which is 0.8 into 11%. Market return is the same, risk-free return is the same. If you will solve it, I believe you will get how much? So you will get 10%. Just check it. Recheck your calculations, okay? Required rate of return. Okay, and then if you will solve the C, for the C, how much is the required rate of return? Just take risk-free return, which is 6% plus beta. Beta you have to use for the C now, 1.5 into 11%, which is market return into minus 6%. Just solve and I believe you will get how much? You will get 13.5%. Okay. So you got 13.5%. Now required rate of return we got. Now we will compare with the expected return. So here we go, moving just here. So just place the information for stock A, B, and then C. For the A, what is the required rate of return is 13%. What is the expected return is 12%. Okay. Then we'll place for B, stock B, required rate of return is 10%. And expected return is how much? 11% here. Then we'll place for the information for the C. Required return is 13.5. Okay. And expected return is 13% here. And I told you, if your required rate of return is less than expected return, then you should accept. Then you should invest. So here we have to check where we have a less. So here we have a greater. No, it should be rejected. And here we have a less. Yes, it should be accepted. And here we have a greater. It should be rejected. It means only in the B, we should invest in stock B, right? So it means which option is correct? So if you will look at here, we have a option A, B, C, D. So in the D, we got only B option, right? So this is the correct option. So option D is the correct answer. I hope so it is clear, right? Now we got a next question here. So if you will look at the requirement first, they're saying what is the expected rate of return? Okay. Expected rate of return, I told you, you have to take rate of return. Okay, and then you will multiply with their probabilities, right? So you will get weighted average values, right? And then you will make the summation of all weighted average value, you will get the expected rate of return. Okay, simply this is like the probability theory we discussed, right? So last time we also discussed in the lectures. Here we go, let's go through the question. A firm is considering a new investment project that will involve building a large office block. So this is what is construction related project. So the firm's financial analysis department has estimated that the proposed investment has the following estimated rate of return distributions. Okay. So here rate of return, it could be a 5% negative, and for that probability is 30%. Then it could be a 10% positive return. For that probability is 50%. And then there could be a 20% rate of return, but the probability is also 20% for the 20% return. Okay. Now you have to calculate expected rate of return. Okay. Expected rate of return, how you will calculate? You are provided with the rate of return. You are provided with the probabilities. Just you will get the weighted average values now by multiplying these two. Okay. Which two? These two figures. Rate of return into probabilities, and then we will make the summation. So if you will take 5% negative, okay, into 30%, so it will give you 1.5% negative value. Then you will take 10% into 50%, it will give you 5% positive value. If you will take 20% times 20%, it will give you what? 4%, right? And now you will make the summation. Automatically, you will get the expected rate of return. Expected rate of return. So if you will take one, this is minus figure, right? 1.5 minus, you can write in calculator minus 1.5, then plus 5% plus 4%. So you will get 7.5%. This is your answer. Okay, 7.5. So this is simplest question, but this kind of question can also appear in your exam. Okay, the reason why I have included this question because maybe in your exam question they may ask you just to calculate expected rate of return. So you should have idea how to find out. So D option is correct answer. Okay, so we got another question here. So they're saying that a firm has $400,000 to invest into two stock portfolio. Okay, like you have a two stock, maybe A and B, for example. Okay, so you have total $400,000 to invest. So to obtain zero portfolio risk, you don't want to take any risk. So the two stock must be what? Perfectly negative correlated. Yes, there should be a negative correlation. Like one stock, if it is having a plus one, which is called perfect direct correlation. So other stock should have minus one, right? Perfect inverse correlation. So here if you got a gain or loss, so here you will get a loss or gain, right? So the gain on one side will be netted off with the loss of other side, or the loss on one side will be netted off with the gain on the other side. So you always select the securities with inverse correlation. And if you can find the perfect negative correlation, because you want zero portfolio risk, for zero you need negative, perfect negative, like minus one correlation. So it means option A is the correct answer. Okay, perfectly negatively correlated. It should not be equally weighted. No, it doesn't mean you can reduce the risk if you are distributing your money equally into stock A and B. No. From separate industry groups, no, you cannot do this way also. Perfectly positively correlated, no, don't take perfectly positive. The reason, if one will make gain, other will also make gain with the same proportionate. If one will make loss, other will also make the loss with the same proportionate, and here you can get total loss. That is why don't go for perfectly positive correlated. Always go for perfectly negative correlated. So A is the best option. Okay, A is the answer actually. Yeah, so here we go. Next question I'm showing you now. So if you will go through this question first. Okay. So guys, they're saying that an investor, if you will first go through the question, they're saying based on the expected rate of return calculation, simply expected rate of return calculation, which stock should the investor purchase? So we got a two stocks here. Let's go through the question. So they're saying an investor is considering the purchase of one of two common stocks. Okay. So you want to purchase one out of two, okay? You want to invest into one actually company. So the projected returns for the two stocks and the probabilities for each are listed below. So this is Marcel's company stock. This is Gilbreth company stock, okay? So here if you will look M and G company, so we have a rate of return and probabilities, okay? So simply you will calculate expected rate of return. So first calculate weighted average value. How? If you will take 6% into 10%. Just help me with the calculation. So it will give you 0.6%. Okay. Then 4% into 40%. It will give you 1.60%. Then you will take 2% into 40%. It will give you 0.8%. Then if you will take minus 2% equals times 10%, these two figures. It, it will give you minus 0.2%. And if you will calculate expected return, it is going to be 2.8%. Okay. Now, similar way, you will calculate expected return for this stock also. So again, we got a rate of return and probability. Just we will multiply. So you will get weighted average value. So how much is 7% into 25%? 1.75%. Then 5 into 25%. It is 1.25%. Then 0% into 25%. Obviously, it is going to be 0%. Then 1% into 25%, it is going to be minus 0.25% because this figure is minus. Okay. So if you will take the expected return, if you will just make the summation, so expected return is going to be 2.75%. So please, our question is based only on the expected rate of return. So which stock we should invest? Obviously, the stock which is giving us higher return. So higher return is for this company, for Marcel company. Okay, because you have to select one of two, right? One of two. Here you got 2.75%. Here we got 2.8%. So it means this is the best option based on expected rate of return calculation. So Marcel company is the best option. So this is what they're saying based on the expected rate of return in which stock we should invest. So it should be a Marcel, right? Option A, Marcel companies, because it is expected rate of return is slightly higher. Yes, this is the answer. Okay, not second G company. No. Again, we have a Marcel company because its weighted average downside risk is lower. No, it's not about risk because expected rate of return doesn't measure any risk. To measure the risk, we should know the standard deviation and beta kind of things, right? So it's just expected rate of based on expected rate of return. So we should check which investment is giving us higher return. Okay. So not the G. So C for Marcel, we've got two option A and B. So option is the correct because here we are talking about only expected rate of return. We are not talking about their risk. Understood? So option is the correct answer. Understood, guys? We got another question on your screen now. So here we go. They're saying, what is the question? Let's have a look. So let me read because it's just a two-line question. They're saying stock J has a beta of 1.2 and expected return of 15.6%. Okay, this is stock J. Stock K has beta of 8 and expected required rate of return is what? 12.4%. Okay. So then they are saying that what is the expected return on market, like RM, return on market, and the risk-free rate of return. It means they are asking what is the expected rate of return, sorry, what is the rate of return on the market and what is the risk-free rate of return consistent with the capital asset pricing model. Okay, so here we go. So let's write first CAPM formula. Okay, CAPM formula I'm writing. So required rate of return equals what? Risk-free rate of return plus beta into return on market minus risk-free rate of return. So now let's put the values. For example, if stock J is having required rate of return, or for example, our expected rate of return is how much? 15.6%. Okay, 15.6. So I'll assume this is the required rate of return. Okay, 15.6%. So then what should be RM and RM value and return on market and risk return? This is what he's asking. So what we can do here, guys? So simply first we can try this figures into this equation. Try this option. And if you are getting exactly 15.6%, it means your answer is correct. Then option A is the correct option. So let's have a look. So let's keep risk-free rate, how much? 6%. Okay. Beta value is given here for J company is 1.2. Okay, 1.2. Required return is 14%. Great. Minus risk-free is 6%. So if you will solve, I believe you will get, if you will solve this, 14 minus 6 is 8%. Then multiply by 1.2, it's 12%. 1.2, no. It will be maybe just recheck. So 14 minus 6 is 8%. Then times 1.2 and then plus 6. I believe you will get 15.6. And let's try the same option in the uh, K company stock also. So let's put for the K. So for the K, required rate of return is how much? For the K, required rate of return is 12.4. Okay, keep 12.4% equals risk-free rate because I'm putting this option 6% plus 1.2. Oh, no, no, not this beta. I have to keep the beta of K company. Now, beta of K is how much? 8. So 0.8. And I'm keeping market risk is 14% minus risk-free 6%. If you will solve this side and you are getting 12.4, it means option is the correct. Because if you will put this 14 and 4%, 14 and 1.6, 12.4 and 0%, you will not get these answers. It means option is the correct answer. So this is how you can do work based on trial and error. Understood, guys? I hope so it is clear. Just cross check. I believe option is the correct because you are getting the same. I'm not using calculator now. It should be 15.6 and 12.4 if you are solving this side. Okay, great. So we got another question, guys. So they're saying that here we go. Its concept is similar, but the way of testing is different. Now they're saying if the return on the market portfolio is 10%, this is return on market, and the risk-free rate is 5%. Okay, this is RM, this is RF. What is the effect on the company's required rate of return on the stock? They're telling you effect on company's required rate of return. Okay, like effect on required rate of return on its stock of an increase in the beta coefficient from 1.2 to 1.5. Actually, they're asking what is the effect on required rate of return. If beta is 1.2 and then it is moved to 1.5. So what is the effect on the required rate of return? So if you look at the option, they told you 3% increase, no change, 1.5% increase, 1.5% decrease. It means you have to calculate required rate of return under both beta, and then you can see here it is increasing or decreasing with which percentage. Here we go, putting the equation first, CAPM equation. Required rate of return equals what? Risk-free rate plus beta into return on market minus risk-free rate. Okay, first I'm keeping if beta is 1.2. So if beta is 1.2, I'm just trying first. Okay, so 1.2 and risk-free rate is how much? 5% plus 1.2. Return on market is 10% minus 5%. If you will solve, I believe how much you will get. Is it 11%, guys? Can you check the calculation? Then you have to calculate if the beta is 1.5. Please check the calculations on your calculator. Okay, if it is 11%, fine. Then what we will do here, we will try now beta of 1.5. So let's keep the beta 1.5. Return on market is 10%, risk-free rate is 5%, plus risk-free rate is 5%, just changing the beta. Now I believe what you will get maybe 12.5%. Can you recheck on your calculator? If you will just see the required rate of return has increased or decreased. Yes, it has increased. If beta is moving from 1.2 to 1.5. So return has increased. By how much? What is the change in percent? What is the increase? It is 1.5%. Obviously, why it is return has increased? Because risk has increased, right? Obviously, required rate of return should also increase by 1.5%. So C is the correct option. Is that clear, guys? I hope so it is clear. Okay, now guys, we have another question. They are saying the difference between the required rate of return, if you're using, let's assume, CAPM equation on a given risk investment and that on riskless investment with the same expected utility is. Okay, like simply if one investment is risky, whatever return you are expecting on that, okay, if that return and the return on the riskless investment. So what it is called, guys? What do you think? It is called risk premium, right? Because risk premium is what? It's always the difference. It is always the premium. Risk premium mean to say what extra you want on your extra risk, right? On one side, if you are investing in the risk-free rate, in the risk-free investment, on the other side, if you are investing in the companies where you are taking risk, so obviously the return will change, right? And the difference which you are taking, which you are getting on the risk investment and the return which you are taking on the risk-free investment is called risk premium. It's not a beta coefficient because beta is always comparing individual stock with the market, right? Risk of individual stock with the market. It's not a coefficient of variation, it's not a CV, it's not a standard deviations, right? So these things, this is called what? Risk premium. So if you don't know the definitions, these definitions I have explained in the last lecture. Coefficient of variation. What is coefficient of variation? Coefficient of variation is the standard deviation of the investment's return divided by the means return. Okay, so like simply this is the formula for coefficient of variation I discussed last time. So beta is something different. Beta always measures the sensitivity of the investment's return to the market, okay, or to the market volatility. And it is not a standard deviation, because standard deviation is the measure of variability of the investment return, like how much your return can vary. Okay, so that is standard deviation. It is always a risk premium. I hope so it is clear, right, guys? Thank you so much, guys. This is what is the these were the practice question for the topic which we covered last time.